What's up, you beautiful apes? It is your boy Trey from Trey's Trades. I think that's what they call me. And we're back again for another YouTube video. We're going to be going over AMC. There's some freaking insane DD that was put together by a god. This is some god tier Reddit DD. Guys, I don't usually, you guys know this, I don't usually dig through Reddit DD and just read it like this, but this is some freaking insane stuff, and you got to give some mad props to atobitt. This is god tier DD, as it says right here. He deserves 100% of the credit for this. I take no credit. I'm simply the messenger, but this is some freaking stuff that we have to talk about because I've been preaching a lot of the same touch points in here on my channel for literally freaking months, and it is great to have it literally written down in document, official document. So I want to start off by saying that I'm not a financial advisor. It's not financial advice. Please take it with a grain of salt. Obviously, let's get into the video. So we're going to give you the basic rundown. What I'm going to do is go through this red DD, and we're going to give you the touch points of what I think is the most important pieces of this, and kind of lay out the picture of how corrupt the U.S. stock market is. It's freaking nuts. We're going to talk about the malpractice that's literally taken place for years and years and years, which is leading to the AMC and GameStop situation that we see right now, along with small cap stocks, which is why I think you're seeing a little bit of this freaking small cap stock movement that we saw today. But we're going to come into that, right? So anywho, let's start off here with the TLDR, and I'll give you the basic rundown on my opinion and what I'm thinking about each individual piece of this. So the DTC has been taken over by big money. They transitioned from a manual to a computerized ledger system in the 80s. Essentially what this means is they went over from pen and paper over to a computerized algorithmic ledger system, right? And it played a significant role in the 1987 market crash. In 2003, several issuers with the DTC wanted to remove their securities from the DTC's deposit account because the DTC's participants were naked short selling their securities. We're going to go through what this exactly means. Turns out they were right. The DTC and its participants have created a market-sized naked short selling scheme, like a Ponzi scheme, guys. And I'm not even freaking kidding when I say it's a Ponzi scheme. It's crazy. All this is made possible by the DTC's enrollee, Seed and Co. Now, there's some important things that I think we should talk about before we get into this. That's some specific, names, right? So the Depository Trust Company is the DTC. They're a centralized clearing agency that makes sure grandma gets her stonks and the broker receives grandma's tendies. They essentially handle the transactions, right? The National Securities Clearinghouse Corporation, the NSCC, they provide clearing, settlement, risk management, and central counterparty services to its members for broker-to-broker trades, right? So they handle a lot of these broker transactions, right? So the DTC you can think of as handling the specific transactions so that grandma gets her stonks and they receive the money from grandma. The NSCC is exactly how it sounds like, right? It's the National Securities Clearing Corporation. They clear all these transactions, the settlement, the risk management, and the central counterparty services, right? Fixed Income Clearing Corporation, the FICC, provides central counterparty services to members that participate in the U.S. government and mortgage-backed securities markets. So these guys all work in tandem, essentially, to make sure that everybody is getting their stonks, that everybody is paying up for their stonks, and then is going to the appropriate people to make that process happen, right? So if you want to dig through this history, right, I'll leave a link to the specific DD post down in the description box down below. This goes through some of the malpractice that's taken place for years and years and years. Exactly what you're seeing right now in 2021 is happening because of what we've seen happen between, I would say, the early 2000s and now. And it's freaking disgusting. So the DTC was created in 1973. It stemmed from the need for a centralized clearing company. The DTC started off writing things out as physical transactions, right? They're gonna walk through this. All this was done on paper. All the transactions were done on paper, and each share certificate was physically delivered. Very slow, right? It was a very slow process. There was room for human error, right? Which is why they eventually transitioned over to the computerized ledger system. The idea of this was that it could speed up transactions and that there was less room for human error. However, human nature never fails to show itself in its ugly freaking face at every physical opportunity. And what you see here is that there was corruption and manipulation that took place to take advantage of these freaking computerized systems, right? So in 1974, the continuous net settlement system was launched to clear and settle trades using a rudimentary internet platform. In 1982, the DTC started using a book entry only BEO system to underwrite bonds. For the first time, there were no physical certificates, and this is crazy. You really need to pay attention to this. No physical certificates that actually traded hands. Everything that was now performed virtually through computers. Although this was advantageous for many reasons, it made it much easier to commit a certain type of securities fraud. Naked shorting. Does that sound familiar to you? Naked shorting, or the idea of creating IOUs for actual physical stock, right? So hypothetically, in a perfect world, what you're going to do is you're going to short a stock, and what happens is you've got a lender who lends out stock to an actual lendee, right? Somebody who's like, hey, I'm requesting physical stock. Please lend this to me so that I can short it into the market. What you have happening is not actual stock is getting sent out to these freaking people who are shorting, right? So the DTC can underwrite IOUs, send it over to these people who are lending stock, and they can short it into the market. So what happens is, guess what? This guy sells stock into the market, just Citadel, for example. Citadel sells stock into the market. It's an IOU, and you buy that stock. And I've said this a million times on my channel. There's good freaking chances that a lot of the people, a lot of the apes out there who hold actual stock in AMC are holding IOUs, or not actual physical tangible shares. They're not real. They shouldn't exist, right? We're going to get into this as it continues to go on. This has happened since 1982. That was the birth of naked shorting, back here when we had the BEO, the book entry only system, to underwrite these bonds. 1 year later, you saw this adoption of the New York Stock Exchange Rule 387, which meant most securities transactions had to be completed using this new BEO system, or the book entry only system. Needless to say, explosive growth took place for the next 5 years. Why do you think that is? Because you were able to have much faster transaction processes. Hypothetically speaking, you had less room for human error, right? You were able to write out and create more trades and transactions in a much more timely manner, which increased the overall growth of the U.S. stock market, up until you see the crash of the U.S. stock market, which ensued much sooner after. So if you're wondering where the birthplace of high-frequency trading came from, look no further. The same machines that automated the exhaustively manual reconciliation process were also to blame for amplifying the first fire sale in 1987, or the first market crash in 1987. There's some big pieces in this that are important to note, right? Many analysts blame the use of computer trading by large institutional investing companies for the market crash of 1987. In program trading, computers are programmed to automatically order large stock trades when certain market trends prevailed. Essentially an algorithm, right? When X is met, Y is met, Z is met, then you do X, Y, and Z. If this, then that, right? However, studies show that during the 1987 U.S. crash, other stock markets which did not use the program also crashed, some with losses even more severe than the U.S. stock market. So you might be thinking, right? How come if we have, you were blaming the algorithm for essentially a lot of this super fast high frequency trading, a lot of this naked short selling? Why is this the case? Why did other economies that didn't use this same technique that like the U.S. stock market did have the same crash? And he digs into this. This is really freaking crazy stuff. The last sentence indicates a much more pervasive issue was at play here. In fact, the fact that we still have trouble explaining the calculus is even more alarming. The effects were so pervasive that it is dubbed the first global financial crisis. Right? To be fair to the computers, they were programmed by fallible people and trusted by people who did not understand the computer program's limitations. As computers came in, human judgment went out. And I said this at the beginning of the video, my friends, human judgment, human nature never fails to show its ugly freaking face. It is what it is. Fear, greed, it's always this idea of I want freaking more. And that's what you see coming into play here is I want more. Even if it means breaking the law. We're going to get into that as this goes on. Like I said, all this credit goes to freaking atabitt. It's insane. Initial blame for the 1987 crash centered on the interplay between stock markets and index options and future markets, derivatives, right? That's what options are. We're going to refer to that as we go through the video. In the former, people buy actual shares of stock. In the latter, they're only purchasing rights to buy or sell stock at particular prices. Those are options or derivatives. Thus, options and futures are known as derivatives because their value derives from changes in stock prices, even though no actual shares are owned. Nothing inherently bad in and of itself right there. The failure of stock markets and derivative markets to operate in sync was the major factor behind the crash. Now, what does this mean, right? You can use derivatives such as options and futures to really leverage heavily and make a lot of cash. We as the retail investor know this, take advantage of this. So if we know this and we take advantage of this, imagine what institutional investors or the 1% do to take advantage of this. There's a big disconnect here, right? Check this out. Notice the last sentence. A major factor behind the crash was a disconnect between the price of stock and their corresponding derivatives. The value of any given stock should determine the derivative value of the stock. It shouldn't be the other way around. Yet this is what it is. This is an important concept to remember as it will be referenced throughout the post. Excuse me. So essentially what you have here is the value of any given stock should determine the derivative value of that stock, but it's the other way around these days. It really is. Derivatives, options, or futures determine a lot of what the stock market does. Think about it like this. Hedging, for example, right? Gamma squeezing, or futures that will dictate the price of stock down the road, which is actual physical stock, right? You will see, let's say, heavy options trading, either calls or puts, and you will see the stock price be influenced simply by that instead of the other way around. Stock prices go up and thus people buy more options. How many times in the last 3-4 months have you seen a huge amount of options being traded, calls specifically on AMC, and all of a sudden the stock price starts going up because there's a huge spike in X stock or Y stock or Z stock? Not simply because they've been hedged for, but because there's derivatives playing into the equation. These are the big whales, man. I'm telling you. These are toots, and people pay attention to it. And the off chance that the market did tank, they hope they could contain their losses with portfolio insurance. So portfolio insurance essentially is the idea that you get to cover your butt, hedge against yourself with this insurance that will cover any losses that you absolutely have to have, right? A major disconnect occurred when these futures contracts were used to intentionally tank the value of the underlying stock. In a perfect world, organic growth would lead to an increase in value of the company or the underlying stock, right? Organic growth meaning the company fundamentals improve. There's a lot of buying pressure, so inherently the value of the stock and the company increases over time. They could do this by selling more products, creating new tech, breaking into new markets, etc. This would trigger an organic change in the derivative's value because investors would be hopefully more optimistic about the longevity of the company. It could go either way, but the point is still the same, right? So if it goes up, you buy more calls. If it goes down, you buy more puts, right? This is the type of investing that most of us are familiar with, investing for a better future, innovation, growth, etc. I don't want to spend too much time on the crash of 1987. I just want to identify the factors that contributed to the crash and the role of the DTC as they transition from a manual to an automatic ledger system. The connection I really want to focus on is the enormous risk appetite these investors had. And I'm gonna make this full circle, my friends. Think of how overconfident and greedy they must have been to put that much faith in a computer script. Either way, same problem still exists today. So look at this enormous risk appetite these investors had. This is referring to the extreme amount of derivatives trading and naked shorting that has taken place over the course of years and years and years of malpractice within the stock market that derives from the DTC and the participants that are part of that entire process, right? Now this gets freaking sketchy. Check this out. I'm going to talk about three groups within the DTC: issuers, participants, and seed and co. Issuers are companies that issue securities or stock, while participants are the clearinghouses, brokers, and other financial institutions that can utilize those securities. Seed and co is a subsidiary of the DTC which holds the share certificates. These guys are going to really play into the equation, and you are going to be freaking mind blown. Participants have much more control over the securities that are deposited from the issuer. Even though the issuer created those shares, participants are in control when those shares hit the DTC's doorstep. The DTC transfers those shares to a holding account, Seed and Co. They basically hold all stock that should be managed by, the DTC, the issuers, and the participants. And the participant just has to ask, may I have some pretty please with sugar on top, right? So a basic TLDR. What does this mean? So an issuer here, the issuer would be, the person who is issuing out the common stock. The participants are the people who manage this stuff, right? They're the clearinghouses, the brokers, financial institutions that can utilize those securities, right? They can lend them out. The Seed and Co. is the subsidiary that holds all the actual physical stocks. Everything is managed through an online computerized broker and ledger system, right? Now, where's that can of worms? Everything was relatively calm after the crash of 1987 until we hit 2003. And this is some freaking crazy stuff. The DTC started receiving several requests from issuers to pull their securities from the DTC's depository, right? Essentially, you had issuers that wanted to pull out their stock from the DTC depository. I don't think the DTC was prepared for this because they didn't have a written policy to address it, let alone an official rule. Here's the response from the DTC. They essentially said, in its opinion, these issuers have no legal or beneficial interest in the securities they're requesting to be withdrawn from the DTC, right? They were basically saying, you do you, man, but this doesn't seem like the move, right? In its opinion, these issuers have no legal or beneficial interest in the securities they're requesting to be withdrawn from the DTC. Realizing the situation was heating up, they proposed this exact ruling. DTC's proposed rule changes provides that upon receipt of a withdrawal request from an issuer, DTC will take the following actions. DTC will issue an important notice notifying its participants of the receipt of the withdrawal request from the issuer and reminding participants that they can utilize DTC's withdrawal procedures if they wish to withdraw their securities from DTC. And two, DTC will process withdrawal requests submitted by participants in the ordinary course of business, but will not effectuate withdrawals based upon a request from the issuer. Now, this brings us back to this. Participants and issuers, right? Issuers are the companies that issue securities and stock. Participants are the clearinghouses, brokers, and other financial institutions that can utilize those securities. Now, that sounds kind of backwards, doesn't it? So essentially the issuers, the people who basically issue the stock, they control the stock. They get to decide who the participants are, get to actually control the stock that is lent out to these participants. That's supposed to be sent out to the people who want the stock, the clearinghouses, the brokers, the institutions, which eventually gets into the hands of retail investors, right? Honestly, they were better off without the new proposal. It became an even bigger deal when word got out about the proposed rule change. Naturally, it triggered a tsunami of comment letters against the DTC's proposal. There was obviously something going on to cause that level of concern. Why did so many issuers want their deposits back? Now, I'm going to spare you guys some time. This is essentially just people saying, I don't agree with this. This is because, the securities have been the target of manipulative short sellers. This is why we're going to pull out of the DTC. We want to withdraw our funds. We want to withdraw our securities, right? Essentially, what you have here is a big freaking cluster butt crap that is happening right now. I want to swear so bad because I get so heated about this, but People recognize that there's naked short selling, right? They recognize that there's manipulation all the way back here, way back in the early 2000s and the late 90s. And they're saying, look, if we're going to play in an unfair market, we don't really want to play this game. So we want our securities back. We don't want to have to play this. If I'm just going to buy stock for this to immediately go down, what's freaking the point, right? So this is what you got, right? Their securities have been the target of manipulative short sellers. What? I'd be pretty pissed too. Have my shares deposited in a clearing company to take advantage of their computerized trades just to get kicked to the curb with no way of getting my securities back, and then find out that the big participants at your fancy DTC party are literally short selling my shares without me knowing. Get this. How does this relate to right freaking now, right? So essentially what you'd have is these guys manage your shares, right? Let's say that you were supposed to own X amount of stock, but you're actually given IOU, right? So you've got 100 shares. They give you these IOUs. They still have the actual physical shares, and you buy these shares, but they use your actual physical shares to short the market, right? Which essentially creates 200 shares. So they still own your shares, even though you have the actual either IOUs or physical stock, and they create IOUs that go onto the market as shorts. So they're betting against your particular stock by using your own stock to short the market. They're essentially negating your buying power. It's freaking nuts. Does that sound familiar, anyone? I don't know about you, but this trust us with your shares BS is starting to sound like a major con. The DTC asked for feedback from all issuers and participants to gather a consensus before making a decision. Altogether, the DTC received 89 comment letters. 47 of those letters opposed the rule change, while 35 were in favor. This is essentially some of the comments that ensued thereafter. We're going to keep this pretty brief. We are writing to enlist your support of our request to the SEC to conduct an investigation into naked short selling of shares of small cap companies on the OTCBB. They're essentially saying, if we want to make this happen, let's investigate the short selling, which is the exact reason why we don't really want to mess with this anymore. We want to withdraw our securities, right? They're saying, look, this is the exact reason. There's manipulation. There's corruption. There's malpractice happening. We don't want to be a freaking part of this. And they're essentially just saying, all right, if you want to, you want to list this new rule change, at least fix the problem so that we're not worried about getting screwed here. Here's another. As an investor who has been continually burned by an inefficient and poorly organized DTC as relates to naked short selling, I urge you to allow companies to continue to withdraw from the DTC at their discretion. Right? Here's another one. This rule should not be passed because by permitting the settlement of so-called short trades by traders not holding share certificates, naked shorting, the Depository Trust Corporation, the DTC, has shown itself to be incompetent to uphold the law and stop illegal naked short selling. If not complicit in such practices, and therefore a company's only protection from an attack on its stock by such criminal activity may be to withdraw literally from the DTC settlement system, right? They're basically, their way of protecting themselves is, look, we recognize the manipulation, so we want to be able to withdraw our securities to protect ourselves. And it's that simple, right? If the SEC cannot prevent illegal short selling and is unable to police and regulate the DTC to make certain rules are being followed, it must allow the companies whose shares are under attack to protect their investors by withdrawing those shares from the system, the DTC, where they are vulnerable to such attacks. Essentially, like, look, if you're not going to protect our backs, at least let us take our money out so we can cut our losses, essentially, and not get absolutely screwed by the fact that you're stealing money from us and the retail investors, our customers, our clients who trust us to make them money, right? Here are a few in favor. This is essentially saying we believe that this is a good thing to do because it's going to make us more money. We'll be able to continue to naked short sell. This actually helps us out, which is freaking mind-boggling. It just shows you how messed up the system is. 2, 3. I mean, I'll leave the link, like I said, down below if you want to read through this stuff. But I want to dig through what's really freaking crazy about this. I realize there are advantages to paperless securities transfers. However, it is exactly what Michael Sandos said in his comment letter above. We simply cannot trust the DTC to protect our interests when we don't have physical control of our assets. Now, I want to make this full circle, right? This idea of we probably shouldn't trust these people to manage our shares. This brings us back to this OTC trading, which we've covered here in the past, and this idea of Citadel managing the physical stock and transactions of brokerages like Robinhood, right? So what happens is Robinhood goes through this OTC market trading, right? It's an unmonitored, unfiltered. This doesn't get registered in the direct, market exchange. Essentially, it's a backdoor OTC over-the-counter exchange where they manage all the transactions for cheaper transaction fees. Citadel, who is shorting the stock, gets to handle all of these transactions. Now, what if Citadel is doing exactly what happened here back in the early 2000s? What if they're getting all this physical stock or IOU stock? Maybe it's being double IOU'd. Who knows? I mean, who freaking knows? It's insane. It's a lot of this finger pointing sort of stuff that's happening right now. What happens if, let's say, the DTC is issuing out stock? Grandma says, here's my money. I want my stock. It gets issued out. And this comes into Robinhood, right? Robinhood gets these transactions. Robinhood now has a stock, and they want to get it filled through Citadel or Shitadel. Shitadel handles these transactions. They're supposed to handle the physical stock, which actually gets handled by Backdoor. And this is where it gets freaking, it's like a huge puzzle of crazy pieces that are working together. But these get handled by, if we come back up here, Seed & Co., right? So I don't even have to come back up. Seed & Co., right? Now, Citadel is handling all these transactions of traders from Robinhood. And they essentially are like, okay, we're going to get this order filled and we're going to send it out to you and this is good to go. So what happens if they're sending out IOUs and this physical stock that's coming in or the IOU that's coming in gets written out as another IOU going into the market as a short order? Who freaking knows? There's no accountability. There's no system that's regulating this. In fact, it's in plain freaking documentation that this is being allowed. I mean, they passed what you're going to see this in a second. They ended up passing this rule. They didn't care. We simply cannot trust the DTC to protect our interests when we don't have physical control of our assets. Several of our participants, including Edward Jones, Ameritrade, Citibank, and Prudential, overwhelmingly favored this proposal. I wonder why. So they can make more money and they can steal from the retail investor. How could someone not acknowledge that the absence of physical shares only makes it easier for these people to manipulate the market, as it has been here so far, right? This rule change would allow these participants to continue doing this because it's extremely profitable to sell shares that don't exist or have not been collateralized. Furthermore, it's a win-win for them because it forces issuers to keep their deposits in the holding account of the DTC. They can't withdraw their security, right? They can't do this risk management. It's messed up. Want proof of market manipulation? Let's fact check the claims from the opposition letters above. I'm only reporting a few for the time period we discussed, 2003-ish. This is just to validate their claims that some sketchy stuff is going on. UBS Securities, Merrill Lynch, and does this ring a freaking bell? RBC, Royal Bank of Canada. I remember seeing their name in the news just recently. I'm not even going to go into that. But these guys have failed to report short sale transactions with indicator, violation of short interest reporting, short sale violation, over-reporting of short interest positions, right? These guys have been busted time and time again for manipulation of shorting because it's a lot easier to drive a stock down than it is to drive a stock up. They feed on the fear and they decide to manipulate the stock because guess what? It's easier for them to pay fines and continue on this malicious freaking manipulation and malpractice and make more money than to follow the rules because they'd much rather pay those fines, right? They'd much rather pay those fines than come clean and do things the right way because they're making more money by just paying the fines and illegally making money in the market, right? Whew. The DTC passed this rule change that we're talking about, right? Ordered that the proposed rule change be and hereby is approved. Essentially saying the DTC is not going to allow people to withdraw their funds. They only prevented the issuers from removing their deposits. They also turned a blind eye to the participants' manipulative short selling, even when there's public evidence of them doing so. Those companies were being attacked with shares they put in the DTC by institutions they can't even identify. So you've got companies that put shares into the DTC, and the DTC, this is the same exact thing that I think is happening with Robinhood. You've got companies, they put in money, they get these securities from the DTC, and the DTC turns around and takes these securities, writes out IOUs to freaking other institutions that ended up shorting the stock with the exact shares that they just purchased, which creates this huge freaking spider web of who knows how many illegal shares, naked counterfeit shares, naked shorting that are circulating in the market, that crash stocks, that create this false selling pressure that drives price down. I can nearly guarantee you this is happening with AMC, this is happening with GameStop, and look at freaking small caps, my friends. Look at small caps. Look at small caps. CTRM, right? CTRM has gotten absolutely schwacked over the last 6 months. Good companies. CTRM is a good company, right? BNGO, good company, right? BNGO, schwacked. Nano Dimensions, right? Good company, schwacked. Just nailed to the cross. Microvision. This is one of the ones that's held up the best, but still this has gotten schwacked. Destroyed. I mean, it's just gotten plowed down to freaking who knows how low. So Medica. This isn't debatable, but I think a pretty decent company. Schwacked, right? Just getting smoked. And this is all these small cap stocks that are getting absolutely destroyed by naked short selling, malicious short selling that's meant to bankrupt companies, steal from retail investors, and make a crap ton of money, right? Whew. Now let's just take a quick breath and recap as you know from this DD, right? The DTC started using a computerized ledger and was very successful through the 80s. This evolved into trading systems that were also computerized but not as sophisticated as they hoped. They played a major part of the 1987 crash, along with severely desynchronized derivatives trading. The idea that you can make a crap ton of liquidity out of leveraged trading through options and futures. In 2003, the DTC denied issuers the right to withdraw their deposits because those securities were in the controlled participants. Instead, when issuer A deposits stock into the the DTC and participants B short those shares into the market, that's a form of rehopification, right? That is essentially manipulation to a freaking T, right? That'd be the same as me going over to you and saying, hey, look, I would like to buy a bike. So here's money, give me a bike. And instead of giving me a real bike, maybe they give me a counterfeit bike, like a freaking piece of plastic that looks like a bike. And I write it down and I realize this isn't even a real bike. And they end up just giving this bike over to this other guy and doubling up on their cash, right? They make 2-for-1 profits on one single bike. It makes no sense at all. In 2003, the DTC denied issuers the right to withdraw their deposits because those securities were in the control of participants instead. We already read through that. Anyways, remember when I mentioned the DTC's enrollees Seed & Co., right? DTC or its nominee Seed & Co. I'll admit it, I didn't think they were that relevant. I focused so much on the DTC that I didn't think to check into their enrollee. Wish I did. You don't really own your securities. Can blockchains fix that? This is essentially talking about Seed & Co., which is manipulating the stock market through the use of IOUs and IOUs and IOUs, right? So look at this. Nearly all publicly traded equities and a majority of bonds are owned by a little-known partnership, Seed & Co., which is the nominee of the DTC. For each security, Seed & Co. owns a master certificate known as the Global Security, which never leaves its vault. Transactions are recorded as debits and credits to DTC members' securities accounts, but the registered owner of the securities, Seed & Co., remains the same. They handle all of this, right? So they hold a master certificate in their vault, which never leaves. Instead, they issue an IOU for that master certificate, which gets written into a million IOUs that creates who knows how many shares that shouldn't be circulating around the market. And it's a bunch of shit. It's just a bunch of shit. Then we just finished talking about why this is such a major flaw in our system, and that was almost 20 years ago. 20 years ago, this stuff was happening, and it's still happening now, and everybody's just turned a freaking blind eye. And this comes back to 2008 as well. All the sort of malpractice that happened in 2008. They just kept pushing the ball down the road, hoping that someone else would have to pick up the problem, and it doesn't go away, right? This is years and years and years of malpractice. It has led us to where we are right now in 2021, which is the AMC and GameStop revolution, is what I will call it, my friends. And this is absolutely insane stuff. Illegal naked shorting series. Who or what is Seed and what role does Seed play in the trading of stocks? When you buy a stock, you are actually purchasing a security that affords certain entitlement rights related to registered stock, which actual owners hold. Seed is a subsidiary of the DTC, which is a subsidiary of the DTCC, and the DTCC is a private company owned by elite Wall Street firms and money-centered banks. Doesn't that sound like vested interest to you? Doesn't that sound like vested interest? The DTCC is a private company owned by elite Wall Street firms. This seems like it keeps coming full circle. Coming full circle. If you need background or refresher on DTC and DTCC, blah, blah, blah. Effectively, elite Wall Street firms and money-centered banks, not institutions and individual investors, own almost all of the registered shares of publicly traded companies in the U.S. While you may think you are buying registered stock, you are actually buying a financial derivative related to that stock. Effectively, you are buying a financial derivative from brokers of a financial derivative they hold from Seed that is just a digital entry in your DTC account. IOUs on IOUs on IOUs on IOUs. We probably don't even know how many shares are actually circulating on AMC. It's no freaking wonder that the company wants to do a share recount, because who knows how many shares are actually circulating. I remember reading that people hypothesized there was 2 billion shares actually trading on the market for AMC. And I don't even find that mind-blowing anymore. I've said this before. Let's look at this, right? Back when AMC traded at $25. It hit $25 on January 27th. I'll never forget this date. Let's look at the daily volume, right? Check this freaking out. We saw 1.2 billion shares in volume, and at the time we had about 150 million total shares of free float in the market. So in order for this to make any sort of logical sense, you would have to have the free float circulate in the market 1, 2, 3, 4, 5, 6, 7, 8 times. 8 times over the free float would have had to circulate in the market. How do you think that's freaking possible? How is that possible? How is that possible? I mean, think about this. If you had options at just a $10 strike and the stock was trading at the day before, $4, you had 30,000 of them. That would be 3 million extra shares that they probably didn't even have, right? At just $10 when those go into money they get hedged for, which drives the stock price up. How many of those do you think were IOUs? How many of those do you think were actual shares? I can willing to bet you this. The majority of those were probably not actual physical shares. There's no possible way you would have the entire float of the stock trade freaking 8 times over. 150 million shares and you saw 1.2 billion of volume? Bullshit. Come on. There's no way. There's no freaking way. This comes full circle, guys. You want to know the best part? I found a list of all the DTC participants that are responsible for this mess. I've got your name, number, and I'm coming for you, all of you. This is some freaking crazy stuff, guys. I cannot believe how full circle this comes. And I've talked about this a million times. The naked short selling that we see, the laddering, the short ladder attacks, the counterfeits, the IOUs, the failure to delivers, all this derivatives, all the liquidity that would transfer from the DTC over to us. It's no freaking wonder they don't want this to happen. It's no wonder they keep pushing the ball down the road, because it's going to cost trillions of dollars for them to pay up. Now, where's the light at the end of the tunnel, right? Where's the light at the end of the tunnel? You're probably thinking to yourself, well, if this has happened for so freaking long, why would they not just keep doing it? Why would they not just say, look, too bad, we're not going to pay you. We're just going to halt trading. We're not going to let this go through because it is going to break trust in the U.S. economy and the U.S. stock market, and that will never be regained. I'll tell you this right now. They're way better off giving us the trillions of dollars in liquidity and putting the Band-Aid on this freaking massive tank wound than destroying the economy for 10, 20, 30 years, because that's what would happen. I'll guarantee you this. If AMC and GameStop don't come to fruition, if this starts squeezing and they shut it down somehow, I will tell all my kids, I'll tell all my friends, I'll tell everybody I know to stay the frick away from the stock market, because that breaks all trust from the U.S. economy and the retail investor and the institutional investor. Bank on us. They make money on us. They cannot let that happen. They make money by taking from us, right? They're way better off paying over the trillions of dollars. I'm certain of this. If they shut this down, the U.S. economy will crash forever. I shouldn't say forever. Man, it freaking feels like it. Oh my God. Whew. Okay, so that was the breakdown on this freaking DD. Atobitt, you are an absolute legend. That was some stupid good due diligence, and I want to give mad props where props is due. This is simply my interpretation. If there's anything that you don't agree with, you want to counter argue any of the points that were made in this, please let me know. That was my interpretation of the data, but that is what I've got for you guys today on this video. If you enjoyed the video, please drop a like. It really does help support the channel, and consider subscribing if you'd like to see more content like this. Lastly, I have an affiliate link in the description box down below for Webull. This is version 4 for the desktop. It's a great platform that allows you to start trading at 3M in the pre-market. Use my link and get 2 free stocks with a $100 deposit and not receive a free stock. Great to support the channel, my friends, and if you're not interested, it's totally fine. I just appreciate your support by taking the time to watch my videos. That is what I've got for you guys today. Thank you for watching, my friends, my family, my fellow Gorilla Gang. Keep aping on, keep hodling on. We're going to win this freaking war, and peace out.